Hi there, I'm here with Jonathan Webster Smith, the investment manager for the Brunsden Asset Management Investment Funds, and we're going to be looking at both the past, the present and the future. The Brunsden Asset Management Funds have now been in existence some 4 years, and between the Cautious and the Adventurous Fund there's over £60 million now invested in them. So first of all, let's look at the year 2015, and Jonathan, welcome. I wonder if we could reflect for a few moments back on 2015 into what was obviously quite a difficult time for investments. Perhaps you could talk us through it and how you adjusted the funds accordingly, please.
Certainly, but I mean, looking back over 2015, it was unquestionably a very difficult year. We started the year with a significant oil price drop. We then had situations where Russia invaded Ukraine. The Greek bailout situation, which we all hoped was dealt with, came back to the marketplace. Over the summer, we had issues with concerns, I should say, over global growth, particularly in China, and how that would impact on equity markets. And then towards the end of the year, we had a more positive tone, which was China cutting interest rates, which surprised the market and led to a rally in the last quarter. Despite all of this, I'm pleased to say that both funds had a positive return for the year, were significantly ahead of their benchmarks. And asset allocation decisions made throughout the year obviously have added a significant amount of value to your investors.
Okay, and what performance was achieved by the two funds?
The Cautious Fund returned 1.4% and the Adventurous Fund 5%, which was 4.5% ahead of its benchmark. So we're very pleased with that.
So good performance, net of charges, in trying times. If we bring ourselves through now to 2016, and of course the fact that the US have just increased interest rates, how is that going to reflect on the UK economy and into our BAM funds in particular?
I think the change to increasing rates, obviously the US has led the way, is going to have a significant impact on markets. I don't think we're quite at the situation where we're going to have a consistent rate rises either from the UK or indeed from the US. I think we may well see one more rate rise. I think they had to do the rate rise in December from a credibility point of view, but the start of the year has seen the oil price fall further, and that has pushed back inflation expectation, which has given both the UK and US central banks more time to think, and what I suspect that will lead to a slightly more gradual pace of increase for interest rates. But I do see the UK raising rates this year, and clearly that will have an impact on some asset allocation decisions that we make. But again, we, like the central banks, will be watching the data ahead of making any changes.
Jonathan, you mentioned the oil situation there, and of course we know that the current price for oil is, I believe, $35 a barrel. We get questions about fracking from the United States in particular. At what point does fracking become economical?
I mean, fracking is one of the reasons that we've seen a significant oversupply of oil at a time where demand has been falling over a number of years. This oversupply was principally the cause for the price to fall. Fracking, it's believed to be economical at $55 a barrel, so there is some incentive from the Saudis and other oil-producing nations to keep oil below this price.
Okay, so general thoughts for the future then. If we were looking over 2016, 17 and 18, some 3 years viewpoint, bearing in mind that these are long-term funds that we're invested in, what are your general thoughts?
I think we're at a critical or turning point in the markets as we move towards a rate tightening situation globally. As I said, I don't think we're there yet, but we're certainly heading in that direction. There is going to be a time to move away from the more developed markets where we've been overweight and successfully positioned, to the more emerging markets and resource-based investments, cyclical-based investments. Because what we've seen over the last 2 to 3 years is valuations across all those markets has fallen significantly, and there is going to be a chance for significant potential upside at some point. But what we're waiting for is to see how the rate rise that's happened within the US impacts those countries, particularly in the emerging markets, given the excessive debt situation that's built up over the last 5 years.
One final question, Jonathan, before we close off. We often get a question with regard to active fund management versus passive fund management. Of course, the Brunston asset management funds are actively managed. I just wonder what your take is currently on that.
Well, certainly, we use active asset allocation and indeed active stock selection, which doesn't mean we won't use passive tracking type investments if we think that's the most appropriate. The danger and what we've seen this year is a significant outperformance from the active management side, particularly in regard to the UK investments that we've chosen that have been overweight to the mid and small cap area of the market. What you generally find with passive UK tracking investments is you have a over concentration to the top 20 companies of the FTSE 100, which in this case has given you exposure to financials and indeed energy and resource companies, which is probably the areas of the market you didn't necessarily want to have a significant exposure to in 2015, given resources fell about 35%. So again, it's important to select your market, but then also what type of investment you want to gain access within that market, and we fully believe that active management will pay dividends over time.
Thank you, Jonathan, for coming along today and answering our questions. Just in closing, I would like to remind you that the Brunston Asset Management Funds are actively managed funds and they are performing above their benchmarks. So positive returns, and that's always good news, and long may it continue. Thank you.